No, we're not surprised at all. I mean, it fits very well with our view that developed market equities, particularly the US, are likely to be the best performing assets this year as well. And if you think about the Fed stance itself, the very fact that they commenced tapering earlier than market consensus expectations by itself was a great signal that they were fairly confident in their outlook for the US economy. And the economic data we received the last 2 weeks of December, if anything, supports that fact. And if you look at indicators like your NEHP house price index, you're looking at durable goods, ISM manufacturing, I mean, everything we saw from about 15 December onwards was very, very strong. So, it matches with our view. It clearly fits with the recent economic data. And I think the minutes really sort of back up what we saw in terms of actual action from the Fed. So, all in, really quite a consistent picture in our view. I mean, it's possible, but it's not something we're really taking a strong view on. I mean, to us, the Fed has already started on the path of tapering. And given that they've started, it's very hard for them to say that, we're going to pause or potentially cut back on it. Increasing the pace, yes, it's possible, but in our view, the market has already moved beyond this point. And by the time we reach, the second quarter, it's very likely, the conversation will already shift to what after tapering. So in that sense, whether tapering ends a little faster or a little slower than what, the current pace allows for, to us will not have a tremendous impact on markets. To us, it's really about, what the market moves to price in terms of when the first actual rate hike might occur. In our view, that will be, well into 2015, not sooner than that. But of course, market expectation could vary. And to us, that will be the key question, in 2014. Well, with India, the concern is not any different to what it was a few months ago. I mean, in India, there are two primary concerns for foreign investors at the moment. One is the fundamentals themselves, that if emerging markets more broadly, begin to sell off, not due to risks in India, but due to risks anywhere else, investors are still concerned that India may be affected. I mean, partly because a country still runs a current account deficit, even if it temporarily reduced at the latest reading. But the second is that the political cycle does make it fairly difficult to invest. I mean, market behavior over the past few months has made it fairly clear that they're looking at elections in a fairly binary way, where, if we have a strong single government that's, capable of making strong decisions, they're, treating that as a positive outcome, while, a fractious coalition would, of course, be negative. And that makes it, very difficult to predict a market outcome. It makes for a very difficult investing environment. So we believe that's also clearly a concern. It's a concern for us, so we're really taking more of a neutral stance until the risk reward ultimately improves and things become clearer.